Let's work on exercise 5-16 now and see what information we have over here that makes it a little different from the previous exercises. We're not going to be working on part A, which deals with the CVP graph. We're going to do part B and part C. The information presented is that Glacial Company estimates a variable cost to be 62.5% of sales and fixed cost will be $600,000. The selling price of the product is $4. So the information is the same as we've seen before. They've just kind of thrown us off a little by giving us a percentage instead of a dollar amount. Nothing to worry, we can work through that very easily. They've asked us to calculate the break-even point in units and break-even point in dollar. We know how to do that. We know the formula. What's new over here in this particular exercise is they've asked us to calculate the margin of safety in dollars and as a ratio, assuming that we have $2 million in sales. Let me get to my Excel spreadsheet here, and let's see how we're going to approach this exercise. So to start with, I know sales less my variable cost gives me my contribution margin. So let me write the word less over here as we're used to seeing it. Okay. I know my selling price per unit is $4. I know variable cost per unit is 62.5% of the sales price. Always when they tell you variable cost or contribution margin, it's off sales, which means sales is 100%. So 100% minus 62.5% gives me a contribution margin ratio of 37.5%. We can now plug in the dollar amounts over here. Either you can do 62.5% of $4. Let's do that calculation. That gives us $2.50. You can then do $37.5% of $4, or simply take the difference between 4 and 2.5 and arrive at $1.50 as a contribution margin. So what we have over here is the information as a ratio and per unit, which is what we need for solving our problem for break-even analysis. But we also need the information relating to fixed cost. Oops. Information given to me as fixed cost is $600,000. And for part C, they've told me that my actual sales is $2 million. We'll use that later on in part C. So let's start out with give me a second over here. My break-even point in units is fixed cost divided by contribution margin per unit. We've seen this in the previous exercises. Fixed cost is $600,000. Contribution margin per unit is $1.50. So 600,000 divided by $1.50 gives me 400,000 units. The next thing I have to do is calculate the break-even point in units. I can take this 400,000 and multiply that by 4, or I can do fixed cost divided by contribution margin ratio, and that answer gives me $1.6 million. This is a break-even point in dollars. Now, what's new in this particular exercise is the margin of safety. Margin of safety is nothing but actual sales minus break-even point. So this is how much I'm above my break-even point. Remember, at break-even point, net income is 0. So I'm looking at how much I am above that break-even point. So I'm $400,000 above the break-even point. Now the same thing if I had to express it as a ratio. If I had to express this as a ratio, I would calculate this as margin of safety, which I just calculated in the previous step, divided by actual sales. So 400,000 divided by the $2 million in actual sales tells me that my margin of safety ratio is 20%. I have a 20% ratio. If I drop by 20%, I'm still okay, as in I don't suffer a loss. Anything below that, I'm going to start going into the red and I'm going to have a loss. Again, always remember, a company is concerned about the break-even point because they want to know what's the point at which at least they can walk away saying, I didn't lose any money. Obviously, no one wants to be in that situation. They want to be above that. But if this margin of safety is not a very comfortable number, making changes becomes a challenge. And we'll see that in the next homework assignment.